Welcome back to another episode of Give Me Some Truth. In the booth today, we have Mitch, Clint, and myself. We're talking about index funds. I don't know if you'd call it exciting. It's exciting to us, but it's a bedrock of investment in most people's portfolio now. And it seems to have some interesting buzz even for people that don't do what we do for a living.
That's right. I mean, every article that you read, it kind of says, well, you should consider index investing.
Right.
But I think, today, I think our goal here is to kind of break down what does that even mean? I think people don't even understand what index investing means. They just think of, I've heard this thing called the S&P 500, and I have no idea.
Yeah, it's almost one of those things in nomenclature where you know the term, but you don't quite understand what it is for a lot of people or kind of how it works, that kind of thing. It's a topic we tend to cover a fair amount in meetings.
Yeah, and then people just go, I want that.
Yeah, right. Yeah, they know they want it, but they don't really know what it is or how it works.
Yeah.
A lot of times people get
Mitch has a cold.
I have a cold. I'm sorry. This is me.
It's the
believe it
Barry
or not,
White.
It is Mitch.
He's got a little
stuffy, a little cold. It's Maddox's fault. I already told everyone that. That's my son, for those that don't know. But a lot of times we get these headlines, whether it's news pushed to your phone, and it's just, the market was up or the market was down, and people just think, there's just this one master universal index.
Right.
There's a lot of indices out there, turns out. So some are pretty vanilla, some are kind of exciting. Hopefully we address both of those topics on the podcast today.
For sure. And I think what it comes down to is that an index is just a basket of something, right? And oftentimes when you look at an index, you'll see the name of the provider that developed the index first. So it's kind of a brand name. Mm-hmm. So, fortunately for Standard & Poor's, the S&P 500 is really the 500 largest U.S. companies by market capitalization. That sounds complex, but really it's not. It just means if you're big, you're represented higher in the index. And it's just 500 companies, and Standard & Poor's developed this index. And so they constitute this index. So they're putting all of these different companies in the index and weighting them. And so other ones that you see might be like MSCI, again, Standard & Poor's, and Spider, SPDR. And so there's all these different, which would be State Street and BlackRock, and all these guys, develop their indexes, and that's sort of the licensing that they have. And then the fund provider builds a fund around it, oftentimes replicating that index.
Yeah, and I think the S&P 500 is probably the best one to point to in terms of it's the most replicated index regardless of the brand, right? So in other words, whether it's Vanguard's, whether it's State Street's, whether it's BlackRock, it doesn't matter. They're all basically having the same 500 companies, represented, as opposed to other indexes where they might not be constituted the same way. So the S&P is probably the most truest staying to that list of companies in the index world.
Yeah, I would agree with that. I think that when you see certain indexes, like you see a large cap index, it can have markedly different large companies and different weightings inside of it. And so that's where I think it kind of gets interesting as you look at index by index,
right?
Seeing, this small cap index is this mid cap index is this, and S&P does it different from somebody else. So it's constitution.
Yeah, we'll take two steps in the weeds on this just so people have a better understanding of it. So there's roughly a little over 700 large cap companies in the United States. Large cap defined as 10 billion to 100 billion. And so when we say the S&P 500, they're basically slicing 500 of those little over 700 companies and putting them in the basket. So that kind of gives the representation of what we're referring to there. However, if you go to like the Russell 2000, which is a small cap index, right? That is 2,000 small cap companies, but you might have another small cap index that only captures 300 small cap companies. So those two investments are going to be very different than Vanguard's S&P 500 versus Spider's S&P 500.
That's exactly right.
For sure. And another thing that we see out in the industry then, as far as some of these providers, whether it's a mutual fund or an ETF, a lot of times people, and I'll actually interject there a little bit too, because a mutual fund and an ETF is not the same thing. That's not the point of this podcast, but people could say index fund and you could get it in either format, mutual fund or an ETF. But also they might start with the 500 companies, the S&P 500, let's say, but then they'll equal weight it, right? So instead of market cap weighted, you could also see some of these providers where, hey, instead of having more of my weight on the top dogs of the index, right? They might say, nope, we're going to own all those 500 companies, but we're going to equal weight it. Yeah. So then you also see these kind of variations where it starts with an index, and then, now we have the equal weighted index, and then the equal weighted fund.
Yeah, let's clarify that just a moment. So what Mitch is referring to is in the S&P 500, the highest weighted company is the number one company, followed by the second, all the way down to the 500. So you do not have equal weighting amongst all the companies in the S&P 500. You have it weighted in terms of size. So you will get, it is top heavy when you think about it that way. The top 10, 15, 20 names are going to take care of a big portion of that overall index, whereas the bottom 100 are getting very small representation.
That's exactly right. So, when you look at, say, an equal weight index, your smaller companies will be a greater representation relative to, say, a market capitalization weighted.
Yeah.
So, if small caps do well or mid caps do well, that might be a good time for you to have an equal weight index, because you're not going to have the top dogs in there. It's going to be more of those sort of bottom tranche of that fund.
And recently, right, you look at it, they talked the last, 18 months, however you want to look at it, 24 months, the top 8 companies, top 9 companies, right? If you own those, you did very well in your investments. So that drove a lot of the S&P 500, but that's not always the case. And so that's a little bit misleading over the last, year and a half, 2 years of, just buy the S&P and be done with it. Well, yeah, that worked the last few years, but it might not always work that way.
It does seem to cycle. Yeah.
Right.
And I would say that this, we might be looking back at this period of time saying this was the golden age of the S&P 500 index.
Because of those
tops.
8, 10 companies.
Anything that's market capitalization weighted towards mega caps obviously has done very well in recent history. So
and I'll throw a little wrench in that because, and this always seems to be the case, but the NASDAQ doesn't seem to be talked about as much. It's always S&P 500. Case in point, look at us. We kicked off this podcast. Yeah. We're talking S&P because that's what everyone talks about. It's pretty easy to understand. A lot of index funds track it, right? But the NASDAQ is similar in the sense that it's market cap weighted. So some of the big dogs, the Microsofts, Apples, et cetera, NVIDIAs, you'll see those names kind of at the top. But this golden age that you talk about, Clint, a lot of times people say like S&P 500, it's the place to be, it's the place to be the last 10 years, 15 years, right? And you actually look at a lot of those time periods throughout that. The NASDAQ, in particular, if you're looking at the NASDAQ 100, has done much better actually than the S&P 500. And a lot of people aren't really talking about it. Even the tried and true index funds, low cost investors, do-it-yourself investors, they always kind of go back to the S&P. Now, granted, when tech is out of favor, let's say, NASDAQ might do worse, right? And it usually does do a little worse. So the ride might be a little more volatile.
What did it take? 14 years for it to come back to what it did as a peak in 1999.
Right, and I'm talking the last 10
recent
years or so.
History's been kind.
But it's funny because people don't talk about the NASDAQ as much. Right. And by no means am I saying here today, oh yeah, everyone go and buy the NASDAQ, but that's not what I'm saying, but it's just not talked about nearly as much.
Yeah, if we take a step back too and just talk about history just a little bit, in relative terms, index investing is quite young, right? If you look at it, so the advent of it was kind of late 60s, early 70s. There was a paper that was published by Paul Samuelson in 1974 that kind of identified this idea. Vanguard came out with the S&P 500, what was kind of considered the first index fund in 1976. So these are newer concepts, relatively speaking, right? So there's a reason why, if you look at the older generations, they still love individual stocks. Well, why? Because indexes weren't around back then, and I think people lose sight of that fact. And even though they came out and kind of got their first foot on the ground in the mid 1970s, it was a while before they started to really take hold and become popular. And so it's a newer concept, if you will, compared to just tried and true stock investing.
Well, and it's become a lot less expensive to do that kind of stuff because back in the day, then what we had was you'd have to get the index provider. The index provider was doing the licensing, and this is what happens now. But all this democratization of investments has driven costs lower and lower. Right. So, even your regular index funds were relatively expensive to today. I mean, it's a lot cheaper to do that, and it's a lot less expensive now to develop your own index.
Right.
And so people come up with an idea and they say, well, you know what, we're gonna test this idea. We're gonna test this thesis. We're gonna, contact one of these providers or do it yourself, and we're gonna end up making an index. And then we're gonna make a fund that replicates that index and then allow people to invest in it. So that's essentially what happens. And now we're seeing more and more coming up with some ideas and testing it and seeing whether or not something works. So, transitioning into a little bit more of some of the indexes that we might like or highlight, or something that we find interesting, what would be an index that you would kind of like?
Yeah. So now is the point where I'm going to grab my computer, because this is a slight nod to one of our coworkers, Alicia. And she's a gamer. So those that have listened to the podcast, you may or may not know that Alicia games, whether that's electronically on the computer or board games. She's a gamer and she embraces it. And that led me to think of, oh, that's right, there's an index for that and a corresponding ETF that you can invest in. Again, I'm not saying go buy this necessarily, but the index is the Solactive Video Games and eSports Index. So this is one of those things, right? If you happen to be a gamer, let's say, and you want to have some part of your portfolio exposed to that, an indexed investing approach might be a way that, you could carve out a little sleeve.
Because there's probably 20 companies in there, 40 companies.
That is all right. Like so now let's see here, 44 holdings.
44 holdings. There you go.
Yep. Yeah. It's and let's see here. There's over 115 million in assets in the fund. And the other thing we should mention too, some of these unique indices, by the time you invest in it through an ETF, let's say in this example, the expense ratios are a little higher.
Right.
So we started off with, hey, it's gotten lower and lower cost, right? Yeah, if you want S&P 500, if you want NASDAQ, whatever, it can be very low cost to get into that type of investment strategy. But for some of these little more unique ones, expect a little higher expense ratio, right? They're probably not as common. There's not that many products that are tracking this eSports index that I referenced. But I want to throw that one out there because that one's kind of fun.
That's a good one. What's the ticker symbol of that one?
It is Hero.
Okay. They always have good ticker symbols.
I don't know if I track that because, in the video game, there's kind of the primary hero type character. Is that what they're going for?
I guess. I don't know. Okay. We don't have Alicia here, so
Yeah,
that's a good one. Nate, do you have an index that either one that's more serious or one that's a little bit more fun?
All right, I'm going to go with the serious one, and this is going to sound very boring because what we were just talking about, but I'm going to do two, right? So I'll do the fun one first. The fun one is PAWS, PAWZ.
I've heard of this one,
and it's all pet food companies, pet care companies, pet oriented. I mean, it's just an interesting. If you're a pet lover, this is kind of the same concept, right? They just said, hey, let's put these companies together. Let's put it out there. It's something you can go buy, right? And so it's a basket, a grocery cart of stocks, just like anything else. But instead of, the S&P being your milk and bread and staples, it's a very specific, unique subset of companies. Well, I mean, that's okay. That's what somebody's looking for. Why not, right? And that's what the company that develops it think, hey, if this is marketable, let's put it out there. Is it a good investment? Well, that's to be seen, like any of these. But if it markets, and these are, in part marketing companies, guess what? Somebody will buy them. So. All
right, Clint, how about you? What do you got?
I got a couple. Number one, I would say more serious. I think, one of our providers that we use somewhat, First Trust, has developed an index I think is pretty interesting. It's called the Capital Strength Index. And so according to the index provider, this is right from their website, but a security must be a common stock that has a member of the NASDAQ US Benchmark Index, 500 securities by float adjusted market capitalization. And they give some, nuance to that. To be eligible for inclusion, companies must have at least $1 billion in cash or short-term investments, a long-term debt to market cap ratio less than 30%, and a return on equity greater than 15%. So it's called capital strength. So I think that's kind of interesting. And then they rank them by a combined short-term and long-term volatility, and then they take 50 companies, and then they, they have maximums and minimums on things, and then they equally weight all of them and rebalance on a quarterly basis. So, that's kind of everything that's all into it there. I think it's a kind of interesting idea of saying we want these really strong companies. And that's just an example of how they do these indexes in a little more esoteric investments where you might go, well, that might make sense. Do I want something that has, maybe we're looking at entering into a recession, and maybe that's the sort of index I want to follow. And, the reason why you buy it from them is that they have a fund that offers it. You also could look at the holdings and do it yourself. Sure. But then you're buying 50 stocks and you're going through all that. So there's an exercise. That's the nice part about ETFs. You can see what's under the hood. The bad part is that you'd actually have to buy all the stocks and then reconstitute it like they do. A little bit more fun one. I like these two because we're in election year. Unusual Whales Subversive Democratic ETF.
Sure.
And there's
What's the ticker?
That's Nance, after Nancy Pelosi, NANC. And then there's one on the other side for Republicans, which is Cruz, for Ted Cruz. So both of them, these are funds. So they're not technically indexes. They actually benchmark against the S&P 500. But they take the Stock Act filings that they do through the Senate Office of Public Records in the Clerk of House of Representatives and made online. So that's ethics in government requires them to end up disclosing their holdings.
So because their holdings are public, then a company can go in and make a fund basically around the individual holdings.
That's exactly right. So
we'll wrap it up with one final thought. We did not mention the Dow almost at all. So I'll take 2 minutes and just kind of hit on that, because obviously that's the one that gets the most spotlight, that gets the headlines. It's a frustrating one for a lot of us investors because it's 30 stocks. That's all it is. It's not a great representation of the overall market. It gets all the headlines, but really, if you want a true representation of what actually is going on in the markets, broader index like the S&P 500, the Russell 2000 on the small cap side, the NASDAQ, it's a more truer representation. So even though the S&P doesn't get the love that Dow gets, if you really want to understand kind of what happened that day or over a period of time within a broader stroke of the investing world, then that's where you'd want to be. So thanks so much for watching and tuning in. We appreciate it. And we'll be back with another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.